The most dangerous place to keep your retirement money in 2026 is not the stock market. It is not a speculative investment. It is not cryptocurrency. It is the high-yield savings account at the bank where you have done business for the past 40 years, the one earning 4.8% or 5% APY that felt like a smart, safe, conservative decision when you moved your money there. The reason it is dangerous has nothing to do with the bank failing. It has nothing to do with fraud. The danger is coming from inside the account itself, from the interest it is generating, and from the precise, mechanical, entirely legal way that interest income interacts with your Social Security check, your Medicare premium, and your federal tax bracket in a way that the bank's marketing department never once mentioned when they sent you the promotional flyer. There is a specific dollar amount, different for every retiree, calculable in about 15 minutes with the right information, above which keeping money in an interest-bearing account actively costs you more in taxes and Medicare surcharges than the interest earns you. You are not just getting a smaller net return, you are generating a net loss on money you believe is sitting safely in the most conservative financial instrument available. Today, the exact calculation gets explained, the 3 layers of damage get identified, and the specific steps to protect your retirement income from this invisible tax trap get laid out completely. Meet Dorothy, the cautious retiree who made a catastrophic tax decision without knowing it. Dorothy is 72 years old. She retired 4 years ago after 31 years as a pharmacist. She is careful, methodical, and financially conservative. She has a modest pension, Social Security income of $22,800 per year, a traditional IRA worth $340,000 she has not yet begun taking required minimum distributions from, and $215,000 sitting in a high-yield savings account at her bank earning 4.8% annual interest. She moved the money into that account 14 months ago when the bank sent her a promotional mailer. She had been keeping it in a standard savings account earning 0.4%. The mailer said earn 12 times more on your savings. She called the branch. She moved the money. She felt like she had made a smart financial decision. She made a smart banking decision and a catastrophic tax decision simultaneously, and nobody told her. Here is what Dorothy's financial picture actually looks like in 2026 because of that move, and why the 5-figure interest income she thought she was earning has been quietly reduced to a fraction of that amount. Layer 1. How savings interest detonates your Social Security taxation. The federal government uses a calculation called provisional income to determine how much of your Social Security benefit is subject to federal income tax. Provisional income is calculated as follows. Take your adjusted gross income, add back any tax-exempt interest, then add 50% of your annual Social Security benefit. The total is your provisional income. The taxation thresholds work in tiers. If your provisional income is below $25,000 as a single filer, none of your Social Security is federally taxable. If it falls between $25,000 and $34,000, up to 50% of your Social Security benefit becomes taxable. If it exceeds $34,000, up to 85% of your Social Security benefit becomes taxable ordinary income. For married filers, those thresholds are $32,000 and $44,000 respectively. Before Dorothy moved her money into the high-yield account, her provisional income calculation looked like this. Her pension generated $18,000 annually. She had $2,400 in dividend income from an inherited investment fund. Her total non-Social Security income was $20,400. Adding 50% of her $22,800 Social Security benefit, $11,400, produced a provisional income of $31,800. She was above the lower threshold but below the upper threshold. 50% of her Social Security was taxable, generating $11,400 in taxable Social Security income. After Dorothy moved the $215,000 into the high-yield savings account, that account generated $10,320 in interest income during the year. That interest appears on a 1099-INT from her bank. It is ordinary income, taxed at her marginal federal rate of 22% plus state income tax. But its more destructive effect is what it does to her provisional income calculation. Her new provisional income, $20,400 in pension and dividends plus $10,320 in interest equals $30,720 in non-Social Security income. Add 50% of her Social Security, $11,400. and her provisional income is now $42,120. She blew past the $34,000 upper threshold. Now 85% of her Social Security is taxable. 85% of $22,800 is $19,380 in taxable Social Security income, compared to $11,400 before the account change. The difference is $7,980 of additional taxable income that did not exist before she switched savings accounts. At Dorothy's combined federal and state marginal tax rate of approximately 26%, that's $7,980 of additional taxable Social Security income costs her approximately $2,075 in additional tax annually, recurring every year, as long as she keeps the $215,000 in that account. She also pays ordinary income tax on the $10,320 of interest itself at her combined rate, which is another $2,683. Her total annual tax cost associated with the high-yield account decision is approximately $4,758 per year. Her net gain from the high-yield account after accounting for all tax consequences, $10,320 minus $4,758 equals $5,562. She believes she is earning $10,320. She is actually earning $5,562. The bank sent her a 1099-INT for $10,320 and sent her no document explaining that the $10,320 just cost her nearly $8,000 of protected Social Security income. That document does not exist. Nobody sends it, and the bank has no legal obligation to send it. Layer 2. The Medicare Surcharge Time Bomb. The second layer of damage is called IRMAA, the Income-Related Monthly Adjustment Amount. It is a Medicare surcharge that increases your Part B and Part D premiums when your modified adjusted gross income exceeds certain thresholds. Those premiums are set not based on your current year's income, but based on your income from 2 years prior. The tax return you file this spring for 2024 determines your 2026 Medicare premiums. The return you file next spring for 2025 determines your 2027 premiums. For 2026, the first IRMAA surcharge tier for a single filer begins when modified adjusted gross income exceeds approximately $106,000. Dorothy's current MAGI is well below that threshold. She is safe from IRMAA for now, but the danger is structural and forward-looking, and it becomes very real when her required minimum distributions begin. Dorothy is 72. At age 73, she will be required to begin taking required minimum distributions from her traditional IRA. Her IRA balance of $340,000 divided by the applicable factor from the IRS Uniform Lifetime Table produces a first-year RMD of approximately $12,830. Her provisional income will jump by another $12,830. Her MAGI, which now includes her pension, dividends, savings interest, RMD, and the 85% Social Security inclusion, will be approaching territory where IRMAA becomes a real concern within 2 to 3 years, particularly if she experiences a year with an unusually large income event such as a property sale, a Roth conversion, or a larger-than-expected distribution. The $10,320 of annual interest that is already embedded in her MAGI is permanent background noise beneath every future IRMAA calculation for the rest of her life. Every dollar of recurring interest income from the savings account is a dollar that reduces her headroom beneath the IRMAA threshold. It provides no corresponding benefit once the Social Security taxation threshold has already been crossed. It is structural MAGI inflation, permanent, compounding, and entirely invisible until the Medicare premium notice arrives. Layer 3. The Cash Transaction Reporting Trap. The third layer of damage is separate from the tax impact entirely, and it is the one that most frequently catches retirees off guard in a way that has nothing to do with how much money they have or how carefully they have managed their finances. It involves cash transactions at the bank, and the legal consequences of misunderstanding the rules are severe. The Bank Secrecy Act requires financial institutions to file a currency transaction report, a CTR, for any cash transaction exceeding $10,000 in a single business day. This is a regulatory filing made by the bank to the Financial Crimes Enforcement Network. It is not a tax filing. It is not an accusation. It is routine, automatic, and carries zero legal consequence for the person making the transaction. The bank files it. The government receives it. The depositor is never notified. Most retirees will never trigger a CTR because they do not handle physical currency in $10,000 increments. But here is the scenario that catches ordinary retirees more than any other. Someone sells a property, receives wire proceeds, and later withdraws a large cash amount for a legitimate purpose: a home repair, a gift to a family member, a major purchase. A prior CTR is on file because of a previous large cash transaction. Then, having heard that $10,000 triggers a report, they make a subsequent withdrawal of $9,500, specifically chosen to stay below the threshold. That pattern, a prior CTR followed by a just under $10,000 cash withdrawal, is an automatic flag in the bank's transaction monitoring software. The reason is structuring. Deliberately breaking cash transactions into smaller amounts to avoid the $10,000 reporting threshold is a federal crime under 31 U.S.C. Section 5324. It carries penalties up to $250,000 and up to 5 years in federal prison. The person in this scenario was not structuring. They genuinely needed exactly $9,500, but the transaction pattern looks indistinguishable from deliberate structuring to the automated systems monitoring it. The fix is straightforward. Never choose a cash withdrawal amount based on the $10,000 threshold. If you need to make a large cash transaction, make it above $10,000. The CTR that follows is routine, legal, and carries zero consequence. The structuring flag carries the potential for civil asset forfeiture, federal investigation, and legal battles that can last years. And if anyone ever advises you, a friend, a neighbor, a tax preparer, to break a large cash transaction into smaller pieces to avoid the reporting threshold, understand that you are being advised to commit a federal crime regardless of whether the underlying money is entirely legitimate. How to calculate your safe balance. The 5-step framework. Here is the framework for calculating the maximum amount you should keep in an interest-bearing account given your specific income picture. This calculation takes approximately 15 minutes with your financial documents in hand. Step 1. Write down your total non-Social Security annual income. Include your pension, any part-time work income, rental income, required minimum distributions if applicable, and dividend income from any brokerage or investment accounts. Do not include your Social Security benefit itself. Step 2. Calculate 50% of your projected annual Social Security benefit and add that to the number from Step 1. The result is your provisional income baseline, your provisional income before any savings interest. Step 3. Identify which Social Security taxation tier your provisional income currently places you in. Below $25,000 as a single filer or $32,000 as a married filer means none of your Social Security is taxable. Between $25,000 and $34,000 for singles, or $32,000 and $44,000 for married filers means up to 50% is taxable. Above those upper thresholds means up to 85% is taxable. Step 4. Calculate how much additional interest income it would take to push you from your current tier into the next tier, or to push you further above the 85% threshold if you are already there. Subtract your current provisional income from the next threshold. The result is your interest income ceiling, the maximum amount of additional interest income you can generate without crossing into a higher Social Security taxation tier. Step 5. Divide your interest income ceiling by your current savings interest rate expressed as a decimal. If your ceiling is $6,000 of additional interest and your savings rate is 4.8%, divide 6,000 by 0.048. The result, approximately $125,000, is your maximum safe interest-bearing balance. Keeping more than $125,000 in an interest-bearing account at that rate pushes you across the threshold. Running Dorothy's numbers. Her provisional income without savings interest was $31,800, already above the lower Social Security threshold. The distance to the upper $34,000 threshold was only $2,200. At 4.8%, $2,200 in interest is generated by approximately $45,800 in savings. Dorothy's optimal interest-bearing balance is approximately $45,000 to $46,000. She has $215,000. She has approximately $170,000 above the optimal threshold that is silently inflating her provisional income and her tax bill every single month. Where the excess money goes. Instead, the $170,000 above Dorothy's optimal threshold does not need to sit in a low-yield account, and it does not need to be invested in anything risky. Several alternatives preserve capital without generating taxable ordinary interest income that inflates provisional income. The first option is a Roth conversion runway. If Dorothy has traditional IRA funds, she will eventually convert to Roth, redirecting some of the excess savings toward funding a multi-year Roth conversion plan, effectively converts future taxable ordinary income into future tax-free income. The conversion happens now at her current marginal rate. The RMD pressure is permanently reduced. Future Roth distributions do not count toward provisional income. The second option is municipal bonds issued by her home state. Interest on in-state municipal bonds is federally tax-exempt and typically exempt from state income tax. Importantly, tax-exempt interest still flows into the provisional income calculation through a specific mechanism, but the direct federal income tax line on ordinary income is eliminated, and the total tax impact is substantially reduced compared to fully taxable savings interest. The third option is a multi-year guaranteed annuity, or MYGA. Interest inside a MYGA accumulates tax-deferred. No 1099-INT is generated in the year the interest accumulates. Dorothy controls when distributions begin. If she times distributions to years when her other income is lower, after Roth conversions are complete, after RMDs have stabilized, she manages the MAGI impact on her own schedule rather than the bank's billing cycle. The fourth option is I-bonds and certain Treasury instruments in specific configurations. Tax treatment varies depending on the instrument and the timing of redemption, and a qualified advisor can model the after-tax return comparison against current savings account rates for any specific situation. The right combination of these alternatives is different for every retiree. What is the same for every retiree is the threshold calculation, the math that identifies how much is too much for your specific income picture. That calculation is the starting point, and it belongs on paper before any other conversation. Why the banking industry will never tell you this. The bank earns its margin on the spread between what it pays you in interest and what it earns deploying your deposits. The more money you deposit and the higher the rate they advertise, the more deposits they attract. The interest rate is their product. The tax consequence of that interest rate is entirely your problem, and they have no legal obligation to disclose it. When a bank sends a 70-year-old retiree a mailer advertising 5% APY alongside a photograph of a retired couple on a sailboat, that mailer is not a financial plan. It is a deposit acquisition campaign. The bank wants your money in their institution. The bank has no interest in explaining that the rate they are advertising might be costing you thousands of dollars annually in taxes on your Social Security income, because explaining that would reduce the effectiveness of the campaign. Your retirement income strategy is not the bank's responsibility. It is yours. And the only way to protect it is to understand how every financial product you use interacts with every tax mechanism that applies to your income. Your action sequence for this week. There are 5 actions worth taking right now, before this week ends. First, call your bank and ask for the year-to-date interest earned on every account you hold. Write that number down. It is the starting point for your provisional income calculation. Second, run the 5-step calculation described above. Write down your provisional income baseline, identify your current Social Security taxation tier, calculate your interest income ceiling, and divide by your savings rate to find your maximum safe interest-bearing balance. Third, compare your current total savings and checking balance against that maximum safe number. If your current balance exceeds it, you have work to do before December 31st. Fourth, take those 5 numbers, your provisional income baseline, your current tier, your ceiling, your optimal balance, and your excess amount, to a fee-only fiduciary CPA before year-end, not next year. Before December 31st of this year, every month above the threshold is another month of provisional income accumulating against your Social Security protection. Fifth, understand that December 31st is a hard deadline. Once the calendar year closes, the interest is locked, the provisional income is set, and the tax consequences for next year are entirely predetermined. The time to restructure is now, while months remain on the current calendar. The deeper problem. no one mentions. The Social Security taxation thresholds, $25,000 and $34,000 for single filers, were set by legislation in 1983. They have never been adjusted for inflation, not once in over 40 years. The purchasing power of $25,000 in 1983 is equivalent to approximately $80,000 in 2026 dollars. By leaving those thresholds completely unindexed, the federal government has ensured that over time, every middle-class retiree with any meaningful income is slowly and systematically pushed into a position where a growing portion of their Social Security benefits are taxable. The high-yield savings account is the modern accelerant for that process. It is the factor that takes a retiree who is successfully managing within the lower taxation tier and pushes them across the threshold, cleanly, mathematically, and entirely without their awareness until the 1099 arrives in January and the tax bill materializes in April. You cannot count on the system to protect you from its own rules. The bank will keep sending the mailers. The Treasury will keep processing the data. The IRS will keep applying the thresholds. The only variable within your control is your own understanding of how these mechanisms interact and your willingness to calculate your specific threshold, identify your excess balance, and restructure before the calendar year closes. If you have a question about how this calculation applies to your specific situation, your provisional income, your Social Security taxation tier, your IRMAA headroom, or which alternatives make sense for your excess balance, write it in the comments. Every comment is read and responses are provided. If this was useful, please share it with one retiree you know who has a large savings balance and has never run the provisional income calculation against their Social Security threshold. That one conversation could save them thousands of dollars annually that they are currently losing without knowing it. Subscribe to stay current every time something changes with tax thresholds, Medicare surcharge rules, or retirement income strategy that affects what you actually keep from your savings. You deserve to know the rules of the system you are living inside, not just the rate on the mailer. USA Benefit Advisor.